Madrid, 2007. Spain is building more houses than Germany, France, and Italy combined. Construction cranes fill every city skyline. New airports open in towns with barely any passengers. High-speed rail lines connect cities that don't need them. Ordinary Spaniards are buying second and third homes. Banks are lending to anyone with a signature. Property prices have tripled in a decade. Everyone believes it will last forever. 1 year later, it will all collapse. Unemployment will hit 27%. An entire generation will be locked out of the job market. Banks will need 100 billion euros in bailouts. And Spain, once the economic success story of Europe, will become a cautionary tale about what happens when cheap money meets national delusion. This is the story of how Spain built an economy on sand and learned too late that you cannot borrow your way to prosperity. To understand Spain's boom and crash, you need to see where Spain was in the 1990s. For most of the 20th century, Spain had been Europe's underdog. Decades of dictatorship under Francisco Franco, from 1939 to 1975, had left the country isolated, underdeveloped, and poor compared to its neighbors. While France, Germany, and Britain built modern economies, Spain stagnated under authoritarianism. Franco died in 1975. Democracy returned, and Spain began a remarkable transformation. In 1986, Spain joined the European Economic Community, the precursor to the European Union. Foreign investment poured in. Trade barriers fell. Spanish companies modernized. By the mid-1990s, Spain was growing faster than most of Europe. Infrastructure improved. Living standards rose. The pessimism of the Franco era was replaced by cautious optimism. Then came the euro. In 1999, Spain joined the Eurozone, adopting the euro as its currency. For Spain, this was a historic moment. It meant recognition as a modern European economy. It meant access to the most stable currency union in the world. But it also meant something Spain did not fully understand at the time. Spain would no longer control its own monetary policy. Interest rates would be set by the European Central Bank in Frankfurt, not by Spanish officials in Madrid. The ECB would set rates to manage inflation and growth across the entire Eurozone, Germany, France, Italy, Spain, and others. And those rates were set for an average European economy, not for Spain specifically. This would prove catastrophic. The European Central Bank's interest rates were designed for Germany, Europe's largest economy, which was struggling in the early 2000s with slow growth and high unemployment. For Germany, low interest rates made sense. They encouraged borrowing and investment. But for Spain, which was already growing rapidly, those same low rates were like gasoline on a fire. Suddenly, Spanish banks could borrow money from the ECB at rates near 2%. And they could lend that money to Spanish borrowers at 4, 5, or 6%. It was almost a risk-free profit, so the banks lent aggressively. Spanish households, which had historically been conservative savers, suddenly had access to cheap mortgages. You could buy a home with almost no money down. You could take a mortgage for 100% of the property value, sometimes more. Banks were lending 40-year, even 50-year mortgages, and property prices were rising fast. A modest apartment in Madrid that sold for 100,000 euros in 1998 was worth 200,000 by 2003. By 2007, it was worth 300,000 or more. Everyone could see it. Your neighbor bought a flat and made money. Your coworker bought a second home on the coast. Your brother-in-law became a real estate agent and was driving a BMW. The logic became inescapable. Property always goes up, so borrow as much as you can and buy. By 2005, Spain was experiencing a full-scale housing mania. Construction became the engine of the economy. In 2006, Spain built over 800,000 new homes, more than Germany, France, and Italy combined, despite having a much smaller population. The construction sector employed over 13% of Spain's workforce. Immigrants poured into the country to fill construction jobs. Spanish banks lent not just to home buyers, but to developers building entire new neighborhoods, not just homes. Spain built airports in small cities with barely enough passengers to fill a single flight per day. High-speed rail lines connected cities that had little traffic. Sports stadiums, conference centers, convention halls, all financed with cheap debt. The regional governments called autonomous communities competed to outdo each other. Each region wanted its own airport, its own train station, its own grand infrastructure project. No one asked how these projects would be paid for when the economy slowed. No one imagined the economy would slow. The first cracks appeared in 2007, not in Spain, in the United States. American subprime mortgages began defaulting. Investment banks holding mortgage-backed securities faced losses. Credit markets tightened. By the summer of 2007, global financial markets were showing signs of stress. Banks became wary of lending to each other. Liquidity dried up. Spain's banks, which had borrowed heavily in international markets to fund their lending spree, suddenly found refinancing harder and more expensive. But the real shock came in September 2008. Lehman Brothers collapsed. Global credit markets froze. Panic spread. Spanish banks, which had always presented themselves as conservative and well-managed, were suddenly facing a crisis. They had lent trillions of euros based on the assumption that property prices would keep rising, that borrowers would keep paying, that the construction boom would last forever. None of those assumptions were true. By late 2008, Spanish property prices had stopped rising. By early 2009, they were falling. Construction projects ground to a halt. Developers who had borrowed millions to build new housing estates could no longer sell units. They defaulted on loans. Homebuyers who had taken mortgages at peak prices found themselves underwater, owing more than their homes were worth. Banks that had lent aggressively based on inflated property values now held loans backed by collateral that was plummeting in value. And the Spanish government, which had relied on construction-related taxes for a huge portion of revenue, watched its budget collapse. In 2007, Spain had been running a budget surplus. By 2009, it was running a massive deficit. The construction cranes stopped moving. That was the first visible sign that something was very wrong. Across Spain, half-built housing developments sat abandoned. Airports with no passengers, train stations with no trains, ghost towns, entire neighborhoods built and sold but never occupied. Spanish families who had stretched to buy at the peak were now trapped in homes worth half what they paid. Young people who had taken construction jobs found themselves unemployed with no transferable skills. Banks held billions in bad loans but were not admitting the scale of the problem. The Spanish government, now facing a collapsing economy, had no tools to fix it. Spain could not lower interest rates. The ECB controlled those. Spain could not devalue its currency to boost exports. It was locked into the euro. Spain could not print money to fund the stimulus. Eurozone rules prohibited it. All Spain could do was watch as the foundations of its economy crumbled, and wait for the crisis to get worse. By 2009, the scale of Spain's crisis was becoming impossible to hide. Unemployment, which had been under 8% in 2007, reached 18% by the end of 2009. It kept rising. By 2010, it hit 20%. By 2011, 21%. By 2012, 25%. 1 in 4 working-age Spaniards could not find a job. But the real horror was youth unemployment. For people under 25, unemployment reached 53% by 2013. More than half of Spain's young people university graduates. Skilled workers, ambitious kids who had believed in Spain's economic miracle had no job. No income, no future. They became known as the lost generation. Families that had stretched to buy homes at peak prices now faced impossible choices. Pay the mortgage or buy food. Keep the house or keep the lights on. Banks began foreclosing on homes. Evictions became common. Entire families found themselves on the street, still owing money on homes the bank had taken. Spanish law was particularly harsh. Unlike in the United States, foreclosure did not clear the debt. Even after the bank seized the home, the borrower still owed the difference between the sale price and the loan balance. Families lost their homes and remained trapped in debt for life. Many left Spain. Engineers moved to Germany, nurses went to Britain. Programmers emigrated to Latin America or the United States. It was the largest wave of Spanish emigration since the 1960s. Those who stayed faced a labor market that had completely collapsed. The construction sector, which had employed 13% of the workforce, shrank by more than half. Hundreds of thousands of construction workers with no other skills flooded the job market. Small businesses closed. Retail shops shuttered. Restaurants folded. The unemployment rippled through every sector. Spain's banks were the epicenter of the crisis. By 2011, it was clear that Spanish banks were holding enormous amounts of bad debt, loans to property developers who would never repay, mortgages on homes worth far less than the loan value, construction financing for projects that would never be completed. But Spanish banks were not admitting it. They kept the loans on their books at inflated values. They reclassified bad loans as restructured or temporarily non-performing to avoid recognizing losses. It was the same mistake Japan had made in the 1990s, the same forbearance that created zombie banks. Spanish regulators, under pressure from the banks and the government, allowed it to continue. By 2012, the fiction could not be maintained. Bankia, Spain's fourth-largest bank, created in 2010 from the merger of 7 troubled savings banks, was on the verge of collapse. It had been presenting itself as solvent, but its portfolio was loaded with real estate loans that were worthless. In May 2012, the Spanish government was forced to step in. Bankia received a €19 billion bailout, but it was not enough. Other banks were in similar trouble. The entire Spanish banking system was undercapitalized, and Spain's government did not have the resources to bail them all out. Spain itself was at risk. June 2012, Brussels. The Spanish government formally requested a bailout from the European Union. The number, €100 billion. It was the fourth-largest bailout in European history, after Greece, Ireland, and Portugal. The European Stability Mechanism, the EU's emergency fund, agreed to provide the money. But the terms were harsh. Spain would have to restructure its banking system. Banks would have to recognize losses. Bad assets would have to be written off. Thousands of bank employees would be fired. Dozens of bank branches would close. Spanish government would have to implement austerity measures, cut public spending, raise taxes, reform labor laws to make hiring and firing easier. For a country already suffering 25% unemployment, austerity was brutal. Public sector workers saw wages cut, pensions were frozen, healthcare budgets were slashed, education spending fell, social safety net that had cushioned. Spain, through previous downturns, was being shredded precisely when people needed it most. Protests erupted across Spain. The Indignados movement, named after citizens who were indignant at the crisis and the government's response, occupied public squares in Madrid, Barcelona, and other cities. Young people camped in Puerta del Sol in central Madrid for months, demanding political and economic change. The protests were largely peaceful but reflected a deep disillusionment. The generation that had been promised prosperity was now facing unemployment, debt, and a government that seemed to care more about banks than citizens. By 2013, the worst of the financial crisis had technically passed. Banks had been recapitalized. The banking system was no longer on the verge of collapse. The ECB had stepped in with emergency support for the broader Eurozone. Spain's economy began showing signs of stabilization. GDP stopped shrinking. Exports increased as Spanish companies found new markets abroad. But recovery for the financial system was not recovery for ordinary Spaniards. Unemployment remained catastrophically high. Youth unemployment stayed above 50%. Wages, for those who had jobs, were stagnant or falling. The housing market remained depressed. Hundreds of thousands of unsold homes sat empty. Property prices continued falling through 2014, and the social damage was permanent. A generation had lost years of their working lives. Skills atrophied. Career trajectories were permanently altered. Families had been broken by economic migration. The scars would last decades. Spain's economy officially returned to growth in 2014. GDP began expanding. Unemployment began falling slowly, painfully, but falling. By 2019, unemployment had dropped to 14%. Still high by European standards, but a vast improvement from the 27% peak. Tourism boomed. Spanish exports grew. The government's finances stabilized. But the recovery was uneven and incomplete. Youth unemployment, while improved, remained above 30% well into the late 2010s. An entire cohort, those who graduated between 2008 and 2015, faced long-term scarring in their career prospects. Economists call it scarring effects. When young people spend years unemployed or underemployed early in their careers, they earn less for the rest of their lives. Their skills develop more slowly. Their professional networks remain weak. The Spanish lost generation will earn less than their parents' generation. They will retire with smaller pensions. They are less likely to own homes. The Spanish housing boom did not just crash the economy. It redistributed wealth from young to old, from workers to creditors, from the future to the past. The immediate consequences of Spain's crisis reshaped the country's economy and society. The construction sector never recovered to pre-crisis levels. The days when construction employed 13% of the workforce were over. By 2015, it employed less than 6%. Spain's economy had to restructure. Services and tourism became more important. Technology and export industries grew. But these sectors could not absorb all the workers displaced from construction. Spanish banks emerged from the crisis smaller, more cautious, and more heavily regulated. Lending standards tightened dramatically. Getting a mortgage in post-crisis Spain required documentation, verification, and significant down payments. The freewheeling lending of the boom years was over, but so was the dynamism. Spanish entrepreneurs found it harder to get business loans. Young families struggled to buy homes even as prices fell because banks simply would not lend. Politically, the crisis fractured Spain's traditional two-party system. New parties emerged. Podemos on the left, Ciudadanos in the center, appealing to voters disillusioned with the establishment parties that had presided over the boom and the crash. Catalonian separatism intensified, driven partly by economic grievances. The region felt it was paying for the mistakes of the Spanish state. The social fabric frayed in ways that would take years to repair. Spain's crisis became a defining case study for understanding Eurozone vulnerabilities. The fundamental problem was simple. Spain had joined a monetary union without a fiscal union. It shared a currency and a central bank with Germany, France, and others, but it did not share a budget. It could not transfer funds from richer regions to poorer ones. It could not use centralized fiscal policy to stabilize regional economies. When Germany and Spain both use the euro and the ECB sets a single interest rate for both, that rate will be right for one and wrong for the other. In the 2000s, it was right for Germany and catastrophically wrong for Spain. This is called the optimal currency area problem. Economists had warned about it before the euro launched. Spain proved them right. The lesson resonated across Europe. Italy, Portugal, and Greece faced similar problems. All had joined the euro. All had benefited from low borrowing costs. All faced deep structural problems when the crisis hit. The Eurozone crisis of 2010 to 2012 was, in many ways, a series of Spain-like crises happening simultaneously across southern Europe. The European response, austerity, bailouts, structural reforms, was heavily influenced by Spain's experience. Some of those policies worked, many did not. Youth unemployment across southern Europe remained elevated for a decade. The broader lesson for global finance was about the danger of credit booms. When borrowing costs fall dramatically and stay low for years, economies do not simply grow faster. They restructure in ways that become unsustainable. Resources flow into sectors like construction that produce assets but not necessarily productive capacity. When the boom ends, those sectors collapse, and the resources do not easily reallocate. Spain built 1 million homes that sat empty. Airports that had no passengers. Train stations that served no economic purpose. The physical infrastructure remains. But the opportunity cost, the thing Spain could have built instead, is incalculable. The story of Spain's housing boom and crash is not unique to Spain. It is a story that repeats itself across countries and across time whenever cheap credit meets national optimism. The United States had its housing bubble in the 2000s. Japan had its bubble in the 1980s. Ireland had a near-identical crisis to Spain's, happening at the exact same time. The pattern is always the same. Interest rates fall, credit becomes cheap, asset prices begin rising. Rising prices create a belief that they will keep rising. That belief drives more borrowing. More borrowing drives prices higher, until something breaks. In Spain's case, it was the global financial crisis of 2008. In other countries, there have been different triggers. But the underlying dynamic is universal. Cheap credit does not create prosperity. It creates the illusion of prosperity. When the illusion ends, the damage is real. Spain lost a decade. A generation entered the workforce during the worst labor market in modern Spanish history. They earned less, achieved less, and built less wealth than they should have. The construction cranes came down. The ghost towns remain. The airports with no passengers still sit empty, monuments to a boom that everyone believed would last forever. The tragedy is not that Spain had a housing boom. The tragedy is that Spain had the tools to prevent it from becoming a catastrophe and chose not to use them. Banking regulation could have been tightened. Lending standards could have been enforced. Fiscal policy could have restrained the boom instead of fueling it. But in the middle of a boom, no one wants to hear warnings. Homeowners want prices to keep rising. Banks want to keep lending. Politicians want to keep winning elections. Developers want to keep building, so the warnings are ignored till it is too late. Spain's housing crisis is over, but its consequences will echo for generations. If this documentary changed the way you think about housing bubbles, financial crises, and the hidden costs of cheap credit, please like this video and subscribe. Subscribe for more deep financial history documentaries.